Most people are told to invest in index funds like the S&P 500, but here's what the wealthy know that most people don't. It's not just about the rate of return, it's about the rate of withdrawal, the losses you avoid, and how much Uncle Sam doesn't get to take.
And great Kite was tagged. Both coaches have come on to try to cool things down. And Tommy, that was a very rough takedown of James Worthy.
Yes, it was.
Hi, I'm Greg Kite with Championship Wealth. If you're looking for a strategy that outperforms index funds with tax-free growth and zero market risk, keep watching. Thank you for joining me here on my YouTube channel. I hope that you'll like, subscribe, and comment on the videos that you see here today and others on this channel. I'd also like to give you a very special offer. I would like to offer you a free copy of the book by New York best-selling Times and my mentor and friend, Doug Andrew, The Laser Fund. The Laser Fund is a fantastic book where you can learn more about our topic today, Index Universal Life, and how it can be a powerful tool in your financial life. All you need to do to get this free copy is participate a little bit. I'd like a little skin in the game. If you're willing to pay for shipping and handling, I'll send this out to you priority mail. If you look down below in the comments, in the description of this video, you'll see a link where you can go and order that book. Many people believe that S&P 500 indexed mutual funds outperform IULs, even after insurance costs. However, that's not correct. Our clients and others with properly structured, annually reviewed IULs have doubled and tripled their wealth in their accounts during market crashes, while others who were invested in index mutual funds took up to 12 years for their accounts to recover. So let's take a deeper look at the numbers and see why that matters. A properly structured IUL links to market indexes, has a 0% floor, and grows, distributes, and transfers wealth tax-free. By linking to market indexes with a 0% floor means you avoid that emotional roller coaster of being invested in the market. So many people, when a market crashes, panic and want to move their money and then out of the market and then put it back in when the markets come back and they miss all the upside. Here, with this strategy, you can get upside gains without any downside losses and sleep better at night. While others lost up to 40%, clients who had annual reviews of their properly structured IULs earned 5% annually and preserved their principal. This resulted in no delay in retirement. When the market crashed in the early 2000s, the dot-com bubble, 9/11, and an ensuing recession, many people lost up to 40% in their retirement accounts. But the top insurance companies that offer these IULs consistently earn about 5% on their general account portfolios. So with an annually reviewed, properly structured IUL, when you're working with a IUL expert, you can gain even while the market crashes and preserve your principal. Here's a look at the S&P 500 and the annual returns for about the past 100 years. You can see that there's more upside, more greens than there are downside reds. And even going back, usually the red periods, the downsides, they're only a year, two, and only twice in that 100-year history we had 3 down years in a row. So one of the beauties of the IUL and having the right strategies, you can eliminate all of those losses, all of those red years, and capture some of the gain of those up years. Let's look at the S&P 500 versus IUL annual returns during the 2000s. So you see that we had down years 4 times during the 2000s with the S&P 500, but of course, because of the zero floor with an IUL, we had no down years. And you were credited interest in all of those up years, but you also could have gained interest through that fixed account in the down years. This decade of the 2000s has been called the lost decade because many investors who were in the market were struggling just to get back to break even by the end of the decade with these market crashes. However, as you can see, those with IULs didn't lose any money and only had gains during this time. Again, in 2008, the market was down 40%. However, IUL clients not only preserved principal, but many grew their accounts from $1 million to $3 million through rebalancing. Let's look at a timeline here. So 2001 to 2003, the market dropped 40%. IUL clients preserved 100% of their principal. 2002 to 2003, could earn 5% annually during market recovery. 2008 crash happened, market fell 40%, IUL clients locked in prior gains, no losses. By 2012, clients grew from $1 million to $2.5 to $3 million with rebalancing. And during this whole period, zero market losses with a 0% floor and tax-free growth. Here's a 40-year performance showdown. Index funds might grow to $5.6 million before taxes. A well-managed IUL, $8 million tax-free. Which would you prefer? With this 40-year look back, $500,000 invested in 1975 with market crashes and recoveries might have grown to $5.6 million, and that's before taxes. But with a properly structured IUL, you could end up with $8 million, tax-free, with no market risk. That's more than double the after-tax result of the index funds that grew to $5.6 million. So what you're looking at is a pie chart of, on the left here, this tax-deferred account with $500,000 40 years ago invested in index mutual funds. It would have grown to $5.6 million, but that's before taxes. This big red chunk here, that's going to Uncle Sam in taxes. However, $500,000 40 years ago in a properly structured IUL could have grown to $8 million tax-free. So that whole pie is yours. None of it goes to Uncle Sam. Traditional 4% rule withdrawal nets $30,000 after taxes on $1 million portfolio. However, IUL clients with $1 million cash value often withdraw $100,000 a year tax-free and don't deplete their accounts. Rebalancing indexing strategy each year boosts returns. Our clients often net 9.6 or more even during recessions. Rebalancing is the key to growth. Even during the 2000s, when 5 out of the 10 years were flat, rebalancing kept IUL clients on track. We teach our clients how to shift between indexing strategies based on market conditions. So let's look at the power of doubling wealth tax-free. 7.2% doubles money every 10 years. 9.6% can double the result over 30 years. That's the IUL advantage. That's the difference between ending up with $4 million versus $8 million, all tax-free. This is why our clients consistently outperform the average financial plan. If you're intrigued by this strategy and want to see how it could work for you, you can go to championshipwealth.com to order your free copy of the Laser Fund. You can also go there to book a quick consultation with me or one of our IUL experts, or get information by joining us at one of our upcoming events. Thank you for watching this video. Please like and subscribe for more helpful tips and to watch our future videos. Comment down below if you have questions, concerns, or if you have an IUL and you'd like to see if you're on track. I'm Greg Kite with Championship Wealth. We'll see you the next time when we tip off another great video.